Money supply has been falling rapidly. What does the falling money supply mean for the economy and for the stock market? Hi everyone, welcome to another episode of OneHedges. Zero Hedge reports that money supply growth fell again in December, falling further into negative territory after turning negative in November for the first time in 28 years. December's drop continues a sharp downward trend from the insane highs experienced since the pandemic. Between April 2020 and April 2021, money supply growth in the US often climbed above 35% year over year, well above the highs experienced in the last decade. Since then, money supply growth has slowed quickly. We are now seeing money supply contract for the first time since the 1990s. The last time the year-over-year change in money supply slipped into negative territory was in November 1994. Money supply is basically all the money in an economy. Checking accounts, savings accounts, cash, all of it. The Fed pumped a lot of money into the system after the COVID pandemic, lifting all asset prices, including stocks, real estate, and crypto. Now all that money is being drained out of the system, leading to declines in the money supply. That's why it's important to track money supply growth, and money supply growth can often be a helpful measure of economic activity and an indicator of coming recessions. During periods of economic boom, money supply tends to grow quickly as commercial banks make more loans. Recessions, on the other hand, tend to be preceded by slowing rates of money supply growth. Negative money supply growth is not in itself an especially meaningful metric, but the drop into negative territory we have seen in recent months does show just how far and how rapidly money supply growth has fallen recently. That is generally a red flag for economic growth and employment. It's not a mystery why short-term interest rates are climbing and why money supply is decelerating. Since January 2022, the Fed has raised the target federal funds rate from 0.25% up to 4.75%. This means fewer injections of Fed money into the market, thereby decreasing money supply in the economy. It should be emphasized that it is not necessary for money supply growth to turn negative in order to trigger recessions, defaults, and other economic disruptions. With recent decades marked by easy money, the Fed has inflated a number of bubbles and zombie companies that now rely on nearly constant infusions of new money to stay afloat. For many of these bubbles, all that is needed for a crisis to occur is a slowing in money supply growth brought on by rising interest rates. Numerous indicators now point towards a recession in the economy, along with the falling money supply and the inverted yield curve. The leading economic index is in recession territory. Real wages have fallen for 21 months. Home builder confidence fell every month of 2022. The Philadelphia Fed Manufacturing Index has been negative since September. Home price growth has been cut in half. The fact that money supply is actually shrinking serves as just one more indicator that the so-called soft landing promised by the Fed is unlikely to ever be a reality. Falling money supply growth, coupled with the recent banking crisis, could risk putting the US under further recessionary pressures and a credit crunch. Take, for example, the recent banking liquidity crisis. Data shows that 400 billion deposits left the banking system last month alone in March. This was the single biggest monthly outflow in US banking history. Most of the money went to money market funds. Credit standards have tightened significantly already. Credit standards were already tightening before the Silicon Valley Bank demise. Startups will likely see the most severe credit crunch in financing because there's no money left in the system. The collapse of SVB and the turmoil at Credit Suisse will turbocharge the effects of QT, sealing the case for a US recession that remains severely underpriced by the stock and the bond markets. The Fed's quantitative tightening effects are now likely to accelerate as the banking stress causes a sharper fall in bank reserves, tipping the economy further into a recession. The Fed is now more likely to end QT and the rate hiking cycle early, but that won't be enough, however, to save the markets, which are significantly underpricing an economic slump. The stock market thinks there won't be a big recession. A fall in bank deposits will lead to less money to go around in the economy, further declining the money supply. This could be the final straw for the economy that is already in a recession. S&P 500 so far is holding on to a thread, but much deeper sell-off lies ahead as recession risks rise. Earlier this week, JP Morgan Chase CEO Jamie Dimon said that the ongoing bank run and near collapse of countless regional banks will force other banks to further tighten lending standards as they enter survival mode and hunker down, effectively grinding all new loan issuance to a halt and sending the US economy sinking. As a reminder, 70% of US GDP comes from consumption. Basically, the economy depends on the US consumer. Without the US consumer, there is no economy. That's a problem because banks with less than $250 billion in assets are responsible for roughly 50% of US commercial and industrial lending, 60% of residential, 80% of commercial real estate, and 45% of consumer lending. As with key segments of the economy locked out of critical lines of funding, GDP will crater and US will spiral into a recession. The new loan demand is plunging, while bank lending standards are approaching the tightest levels on record. Loan demand declined for the fifth period in a row as bankers in March surveyed reported worsening business activity per the Dallas Fed survey for the month of March. Loan volumes, driven largely by a sharp contractions in consumer loans, fell. Banks are giving out less and less loans. This is bad for the economy as loans drive most of the economic activity. Consumer confidence has fallen due to the recent banking crisis and recession fears. Consumer demand is sinking with consumers unable to pay their debt. Money analysts suggest that the economy may have a soft landing, or rather avoid the recession, primarily due to the continued strength in the labor market. While employment remains strong, the rapid decline in growth has been a recession signal. Besides, unemployment rates do not surge until we are deep in a recession. Employment is a critical factor in the recession equation because US consumers drive the economy. It is the bulk of revenue and earnings growth for corporations. Consumers got a boost in savings during the pandemic from all the stimulus checks. That boost has fully reversed now as consumers struggle to pay bills. Currently, nearly 40% of Americans are having trouble paying their bills. Almost 57% of Americans can't afford a $1,000 emergency fund. 68% of people are worried that they won't be able to cover their living expenses for just 1 month if they lost their primary source of income. Nearly 75% of middle-income families are struggling with the impact of inflation. Credit cards are no longer just for luxurious items and travel. For many Americans, credit cards are now the difference between buying food and gasoline or not. Tracking credit card usage is thus an important metric in tracking recessions. As consumers demand larger houses, luxury goods, cars, travel, entertainment, real incomes have fallen and have failed to keep up with the demand. With the near zero interest rates, consumers leverage themselves on the back of cheap debt, particularly since the great financial crisis. However, as the Fed continues its aggressive rate hiking campaign, those short-term rates will feed through variable debt such as credit cards. That's why it's important to gauge credit card usage, because that will give us important clues on how the US consumer is doing. While the market is defined that the Fed will engineer a soft landing, the Fed has never entered into a rate hiking campaign with a positive outcome. Instead, they've either broken something, led the economy into a recession, a bear market, or a credit event that required a reversal of monetary policy. Given the steepness of the current campaign, it is unlikely that the economy will remain resilient as saving rates drop markedly. More importantly, the rate of increase directly impacts households dependent on credit cards to make ends meet. While investors may not think a hard landing is coming, the risk of consumption due to indebtedness and surging rates suggests differently. Importantly, what matters most for investors is earnings will decline and stock market declines as economy slows down. Markets will suffer as recession is priced into the markets. The whole point of the Fed hiking rates is to slow economic growth, thereby reducing inflation. As such, the risk of a recession rises as interest rates choke economic activity. Unfortunately, with the economy slowing, additional tightening could exacerbate the risk of a recession. The media and the White House have proclaimed victory by stating that the first 2 quarters of 2022 were not a recession, but an economic slowdown. However, given the lag effects of changes to the money supply and higher interest rates, indicators are pretty clear. Recession risk is very probable in 2023. We believe that the US economy has already tipped into a recession. Recessions aren't all the same. It takes time for recessions to fully develop. For example, the US housing market is in a deep recession. Other areas of the economy, however, might be holding up, but weakness in those areas will be felt soon as recession becomes more widespread in the economy. The consumer is likely to be the biggest loser. That's it for today's episode. If you like the content in today's episode, please consider subscribing. At OneHedges, our aim is to cut through the noise and give you the data so that you can position yourselves in the markets effectively.